Hey everybody, Kevin coming to you once again with Weeds Weekly, and my apologies for being so late. I was down in Seguin, Texas, had meetings, looking at property, got invited to a Rotary introduction meeting tonight. So again, a lot of travel, very time consuming, great day, but that's why I am so late. So what do we do here at Weeds Weekly? Every week we talk about what's going on in the mortgage space. So we're going to talk about, hey, being on the ropes last week, right? We feel like we're on the ropes. Who is on the ropes? We're going to talk about that. We're going to talk about taking a step back. We're looking at going forward. We're at the lowest point that we have been since March. What does that mean? We're going to get a look under the hood. We get a lot of data sets this week. It gives us just kind of a glimpse of what's coming. And then we're going to talk about being the expert. How should we and what should we be talking about to our clients? Because we got kind of an elephant in the room that's around the corner. So I think it's something really important you want to discuss with your clients so that you can be the expert. And then we're going to talk about the best rates. How do you get them? So let's just recap last week really quick. When I talk about being on the ropes, it's the consumer. We've been talking about it since the beginning of this year, and it really became evident probably right around mid Q1. But the consumer is under tremendous pressure. Inflation has been high, inflation has been persistent, and now we're starting to see those retail sales numbers beginning to pull back. The big ticket items, the consumer just does not have it in them anymore, given that fuel and food is eating up probably a majority of their budget because those prices have skyrocketed so high and they don't appear to be coming down anytime soon. If at all, it's going to be the new norm. So we have the consumer on the ropes. So if you're looking at that from an interest rate perspective, that's a good thing. The other thing that we saw last week is we have builders taking a step back. They're obviously under pressure too. With these higher interest rates, the affordability is a major concern. Their costs are going up, the cost of labor, the cost of material. And what they're finding is, why are we going to begin to pull permits? Why are we beginning all these new starts if affordability and interest rates seem like they're going to be persistently higher for a longer period of time? We're going to be sitting on inventory. That's going to be not cost effective for us. And therefore, we're going to pause a little bit. So we're starting to see a pullback in that as well. The one thing that we did see this past week is we saw that the services PMI came in at its highest point in over 2 years. So what that means is the manufacturing index, the purchasers manufacturing index, their survey is indicating that purchase managers believe that prices are going up. And who is going to absorb that? Well, it's either going to be the company, but more often than not, it's going to be the consumer. So once again, you're seeing that be a problem. But what that does is it pushes interest rates higher, because what that means is the Fed is not done enough. The Fed is maybe not done enough with interest rates, keeping them where they are for as long as they have. Maybe they need to go longer to put more pressure on businesses, to put more pressure on purchasing managers from spending money, right? They need to tighten the economy. That is what the Fed is trying to do. However, they're also trying to avoid stagflation. So what do we have coming into next week, right? So this week, the week ahead of us, we're going to get another peek at the consumer. We have consumer confidence. That number is coming out tomorrow morning. And what I expect from confidence, that's how people feel about the economy. And with interest rates dipping a little bit, I actually anticipate that number will actually be relatively good. But as I said, actions speak louder than words, right? The actions of what people believe is confidence. Like their actions, they're pulling back on purchasing, but yet they're saying, hey, I'm confident because I know interest rates are coming down. So I feel decent, but yet their actions, they're pulling back. They just don't have the capital resources to keep pace with inflation. The other thing is we're seeing is the good news is all these data sets that have been coming out have been indicating that the Fed is probably getting closer to a Fed funds rate cut, which has pushed for the past couple of weeks interest rates across the board from your $300,000 loan amount to your $2 million below the 7% mark. As a matter of fact, I said it on Friday, you got a 780 FICO, you got a $750,000 loan amount, I'm quoting 6.375. We haven't seen rates like that in quite some time. So critical to know those numbers so you can speak to your clients about that. The other thing is, we do have initial jobless claims again. I think what we're starting to see there is we're starting to see jobs pull back. We're getting those initial jobless claims are a little bit higher than forecast every week. And it just seems like what the Fed has done, where the Fed has kept the Fed funds rate, is really starting to eat into the labor market. We're starting to see accelerated layoffs. We hear about them a lot, in the news. And I think we're going to start seeing those reflected over in the jobs numbers. But the biggest data point that's going to come out is going to be on Friday, and that's the PCE. What PCE is, it's the number, the prices for goods and services that people are purchasing. You have the core, and then you have the PCE itself. So there's going to be a number that excludes fuel and food, and then there's going to be a number that has fuel and food in there. But this is a major read, for the Fed, as opposed to CPI. Friday is going to be a big number. And what I anticipate is I actually anticipate that this number to come in a little bit higher. They came in last month 2.7 and 2.8 respectively. This month they have them at 2.6. And unfortunately, I think that forecast is a little bit low. I think economists are expecting that inflation's getting tamed a little bit faster than they believe. And I think this number is going to come in right at forecast, if not a little bit higher. So my recommendation to you is if you have a client that has secured a home and is under contract, to make sure they're talking to their mortgage professional. I would not float into Friday. That's the best advice I can give. Let's now flip to what I'm talking about with being an expert. It's amazing to me that we're about 4 months out from the presidential election and you wouldn't even know it, right? It seems as if it's almost on the back burner. The biggest thing that's on everybody's mind, at least in the space that I run, I get them in the real estate industry, but the biggest thing that seems to be a concern for a lot of people is what is the Fed going to do with interest rates? When is this economy going to turn around? When is the pressure that I'm feeling as a consumer going to be relieved a little bit? So my point is this, is that election is coming. And more often than not, what it does is it puts people in quicksand. So what we need to do as professionals is get ahead of it. Experts are predicting that this is going to be the highest spending election cycle we have ever seen, which only means that in every facet of media, the negative ads are coming, right? Negative ads are what predominantly run, 95% of them. So what we need to do is turn that into a positive. For everyone that wants to feel like they're in quicksand, let them. We need to talk up to our clients as it's an opportunity. It's going to be an opportunity for an excess inventory because you're going to get so many buyers that drop out that want to be in the quicksand. I think that's also going to be coupled with lower interest rates. But I think that you're still going, even though we're going to get lower interest rates, you're going to get a Fed funds rate cut. You got to remember, traders are forward thinking. So give it July, we're already going to see interest rates drop and into August for what they're going to be, even with the Fed funds rate coming. So those people that want to sit on the sidelines and be nervous about the election and uncertain what it means if Trump wins, if Biden wins, and so on and so forth, and what happens and what if, we don't want that rhetoric. We want to be forward thinking with our clients and talking about how it's going to create a better advantage for them. They're going to have better options. They're going to have lower interest rates. And then what typically happens is once we get through that election cycle, we get through the holidays, we see appreciation. All the dust settles, doesn't matter who's elected. We kind of get an idea of what's going to happen with the economy. We absorb it. We say, okay, everyone seems to be fine, or they get excited. Even if you're disappointed, at least you have clarity. And then what you're going to see is things move higher from an appreciation standpoint because you're going to then get future Fed fund rate cuts. Maybe not in November or December, but come 2025, we are going to get a couple, because if you look at that dot plot that I shared with you guys a couple of weeks ago, we had Fed fund managers pushing the Fed funds rate 1 percentage point lower than it is today through 2025. And then the last thing I want to talk about is, my point was, what did I put? The best rates. And I've talked about it before, but it's your FICO score. I can't stress this enough. I can't stress that over my long career, how many deals I've seen or how many people have backed out of purchasing a home or stopped looking at a home because their DTIs were too high, they didn't qualify, or their payment was too high, they didn't want to do that, it wasn't within their budget, and it's all because of FICO. And I want to give you a very quick example of why it's so important. If you take a client that has a $500,000 loan amount, they're both putting down 20%. Someone has a 785 FICO, the other one has a 735 FICO. The difference in those interest rates with regards to the yield spread, the hits, the back end adjustments is $5,625, which is equivalent to a quarter to a half a point in interest rate, because you have to remember, all of us mortgage brokers, loan officers, we make money on yield. So the more adjustments, the higher the rate needs to go so that we can make money as well. That 50-point spread is worth $5,625. So be the best advocate to your clients. I'm not asking and I'm not telling you that you need to be asking them, well, what's your credit score? The question you need to be asking is, do you have a credit score above 780? Because if you don't, I have somebody that you need to talk to. I have somebody that can talk to you with regards to credit, possibly can help you get that credit score up, because your credit score will directly impact your interest rate and the cost to get that mortgage. All right, y'all, I hope that helps. I know it's late. I'm tired. I need to get to bed. I need to get up at 5 o'clock in the morning. And as you can tell, I'm wide awake. So I'm in trouble. All right, y'all, have a great week. Happy selling out there. You need anything, I'm a phone call, text, email away. Wish you the best. Hopefully you digest those couple points that I made. I think they're going to be extremely helpful moving forward. And as I said, have a great rest of the week. You need anything, you give me a shout. Talk to you soon. Cheers.